Hello, everyone. My name is Chris Huntsman, and I'm the Director of Internal Sales here at OneAmerica. Today, we're going to go over the concept of the Great Retirement Income Gap. And the purpose of this presentation is really focus on the simple and easy language you and your clients speak to motivate them to plan now for that biggest potential gap in their retirement income plan. So you should be able to download a copy of today's webinar slides from GoToWebinar. But if you do have any issues and you need me to send them to you, feel free to email me. You should have my email address from when you registered, but it's just chris.huntsman@oneamerica.com. And then also you'll get an email after the presentation today as just kind of a thank you for attending. So you'll get my email address then too if you can't find the previous email and you need any problem or you have a problem getting the slides. So, all right, so before we get started, we'll kind of give compliance their moment in the sun here. I'll kind of assume you're all speed readers here. All right. So the first thing I want to do today before we get into the retirement income gap itself is kind of set the mind frame for preparing for retirement. So if you ask anyone what the goal of every mountain climber is, they're likely going to tell you, well, it's to get to the top of the mountain. But if you think about it, it should really be to get back down the mountain safely, because it doesn't matter if you get up there if you can't get back down. Well, most baby boomers, they've reached that top of that mountain, so they've completed that accumulation phase of retirement. The problem is now they're beginning to retire and enter that distribution phase. So we've got to help them get down the mountain. And that's why we're seeing a lot of focus now on income and income strategies. Now, everyone needs a plan to safely get down that mountain. So here's just kind of a few issues that affect that descent down the mountain for clients. So one, and the obvious one, is just having enough retirement income to begin with. Number two is going to be just the low interest rate market that doesn't seem to be going anywhere anytime soon. So obviously that's having a big impact on the fixed assets part of their portfolio and some of the other parts of their portfolio as well, maybe indirectly. Number three is going to be just rising healthcare costs. You know, we've seen on average anywhere from 4 to 6% over the last 12 years. I wouldn't anticipate that stopping. So just once again, just seeing those rising healthcare costs. And number four, and this is the one that sometimes gets left out and gets forgotten about, but it's having enough income to pay for a long-term care event should one of those arise during your retirement. So now what I want to do is kind of paint that picture together of what that long-term care event might look like if they had one during retirement. So right now, the average cost of care nationally is about $100,375 per year, and that's for a private room in an LTC facility. Now, obviously, we know in some areas of the world or some areas of the United States, it's going to be a little bit higher, some places a little bit less. It's just going to kind of give us a nice national average to work off of. Now, we know medical costs have gone up over the years, and typically, once again, it's somewhere in that 4 to 6% range. But for the sake of this conversation, let's just assume a flat, conservative 3.5% inflation rate for medical costs over the next 10 years. And if we did that, that would grow that 1-year stay in a private room to $141,599 per year. And if we take that out 20 years using that 3.5% inflation rate, that would get us to just under $200,000 per year for that 1-year stay in a private room in an LTC facility. Now, there's several trends that are going to impact that cost of care going forward. You know, first is just higher demand. You know, there's 10,000 baby boomers turning 7 years old every day. And most of the baby boomers are fine health-wise, so we don't really expect this to hit baby boomers for another 10 to 15 years. But when it does, simple supply and demand tells us the cost of care is going to go up because of it. Now, another issue is that by the year 2035, for the first time in the U.S. history, older generations are actually projected to outnumber children. And that's according to the U.S. Census data. And that raises the question of, well, who's going to take care of that aging population? And the second trend that's really going to impact it going forward is going to be longer lifespans. I'm sure a lot of you have noticed this. You know, the medical community is making these huge strides in making us live longer, but unfortunately, there haven't really been any advances in preventing or curing Alzheimer's or other forms of dementia. And those types of illnesses are going to require longer periods of care. You know, I've even seen projections that millennials could have average lifespan to age 110. So our bodies are living longer and longer, but our brains just can't keep up. Thus, we're going to continue to see that average long-term care claim go up both in the duration and in the cost. Then that third trend that's really going to have that impact, and I'm sure this is probably one a ton of you have seen, is just family dynamics. You know, it used to be adult children would stay close to home, But now children leave home and move hours and sometimes states away. With adult children living farther away, there's going to be less informal care being given by adult children and a much heavier reliance on formal caregiving being done by home health care agencies and long-term care facilities. Then that fourth trend that's going to impact it is going to be probably the obvious one, and that's just going to be the government. And no matter how you feel about the government, we can all agree about one thing when it comes to the government, and that's that it's always changing. And when we talk about the government and we talk about long-term care, we're really talking about Medicaid. Well, Medicaid, just like the government, is always changing, and no one can really say what its rules and qualifications will look like in 5 years, let alone 20 years from now. Right now, most states, their biggest expense is Medicaid. And if you kind of think about like you and your household budget, states are no different. They're going to look at their biggest expense first as a way to cut costs. So what's going to be available and who's going to qualify for Medicaid 15 to 20 years from now really becomes a difficult thing to judge. We've already seen look-back periods extended from 3 to 5 years. We've heard talks of extending it to 10 or more years. We've seen states like Minnesota creating think tanks on how to cut Medicaid long-term care spending. We've seen the addition of filial law for a lot of states. And for those of you not familiar with filial law, I'll spell that for you. It's F-I-L-I-A-L. So if you want to do a little bit of Google research, once again, that's F-I-L-I-A-L. And while filial law does a lot of things, it has one thing it does for Medicaid that we all need to be made aware of. It does allow for the states to go after children for the cost of care that's provided to a parent by Medicaid. So all these things that the government's doing and the state governments are doing, they're just the beginnings of ways that states are trying to cut down on the expense of Medicaid. Because this right here, this is the biggest concern. Right now, about 5.6 million Americans age 65 and over have Alzheimer's, which is about 1 in every 10 people age 65 and over, and more being diagnosed every 33 seconds. And we expect this number to more than double by the year 2050. Another stat that's not on this slide is that 1 out of every 3 people over age 65 dies with Alzheimer's or some other form of dementia. And that's according to the Alzheimer's Association. Since that one's not on the slide, I'm going to repeat that one for you in case you're trying to jot that one down. It's 1 out of every 3 people over age 65 dies with Alzheimer's or some other form of dementia. And that's according to the Alzheimer's Association. So all these numbers are just going to escalate in the coming years as that baby boom generation continues to age past 65, when once again their risk of developing Alzheimer's disease is at its highest. So all this just kind of leads to the conclusion that we've got this perfect storm brewing in this country for a dramatic increase in long-term care costs and in the need. So now what I want to do is kind of take that average cost of care in 20 years we projected out on a previous slide. And if you remember, that was $199,725 per year, and see what that looks like over the average length of care. Well, the average length of care according to Medicaid is 2.2 years for men and 3.7 years for women. But keep in mind, that's just for care in a long-term care facility, and it doesn't account for home health care because Medicaid typically does not pay for home health care, barring some kind of major exception. But we're just going to kind of use these numbers now as just kind of an example to work with. So if we use those numbers, as you can kind of see on the screen, that would make the average claim for men in 20 years $439,395, and for women just under $739,000. Then also, as you can kind of see on the screen, if we take the average Alzheimer's claim of 8 years, that would be a claim of over $1.5 million, just short of $1.6 million. Now, obviously, all the numbers on the screen here are just averages, but now ask yourself, how do we get to an average? And to make a point, I'm going to use the average NFL career length, especially since we're in the midst of football season. So think about that average NFL career. So what it would do is it would end with about 4 minutes to go in the fourth quarter, in the fourth game of the fourth season of a player's career. So now you got to ask yourself, well, how many players does that actually happen to? And the answer is none. You know, there's players that play 20 years in the NFL, and there's players that play 1 game in their entire career. And the same thing would really apply here to the averages on the screen. These will happen to almost no one. Some people are going to never have a single day of long-term care, and some are going to have 16 plus years of care. Matter of fact, we currently have a policyholder here at One America in her 16th year of claim with us. Now imagine if she had planned on the average with an LTC policy that only lasted 4 years. She would have spent the last 12 years exhausting her legacy eating up the assets for her spouse's retirement income, and probably in a Medicaid bed, letting the government dictate the quality of care she's getting. So these are all just kind of examples of why we shouldn't plan for the average when it comes to insurance. And if you think about it, the long-term care insurance industry is really the only one where we see a lot of people planning for the average claim. In every other insurance industry, people solve for that catastrophic risk. We protect ourselves from a total loss of our home in a fire, or from cancer when it comes to medical insurance. So why is long-term care different? And if we're honest with ourselves, it's really because we've kind of allowed ourselves to be brainwashed a little bit by the long-term care insurance companies that we need to solve for the average because that's all most of them are willing to sell us policy-wise. So we've really got to retrain our minds and remind ourselves why insurance companies exist. They exist to take that catastrophic risk off of the client. So obviously there's a lot of stats out there in the long-term care industry, and I've already thrown some at you, a lot at you, so I'm sorry about that. But the most popular, and the one I'm sure most of you have seen before, is that 70% of people over age 65 will require at least some type of long-term care service during their lifetime. And of that 70%, 20% are going to require long-term care for more than 5 years. Now, if you'll bear with me, I'd like to share just a quick story that I was recently told by a wholesaler. This wholesaler was meeting with an advisor who said he was kind of struggling with offering lifetime benefits because he was too hung up on the average claim. And he'd kind of been that agent that had been kind of brainwashed into thinking solve for the average when it comes to long-term care. So what I want to do is I want to kind of retell her story to me in her own words. And I'm going to begin that story now from the wholesaler's point of view. So I'm going to be talking as if I'm her. So we were at a client event and the clients began to fill the room. I was at the front of the room just preparing the equipment for the presentation. And the advisor walked up and said, kind of help me understand why someone would want lifetime benefits. Isn't it like 1% that'll actually need it? So I responded, no, it's quite a bit more than that. Let's use this group to paint a picture. So there's 20 clients here today. We know that 20% will need care for longer than 5 years, and many are going to need care due to Alzheimer's, which is an average length of care of 8 years. So if we use that, that means 4 out of the 20 clients here in the room in front of us right now are going to need the lifetime benefit option. Now pick out which 4 are going to need it. Well, the advisor obviously smirked a little, knowing that he wouldn't be able to tell, which ones are going to need it. So went on further to explain, you see, if you'd helped all these people plan for the average, then you would have single-handedly ruined 4 families' lives. Everything they've worked to build, retirement for the surviving spouse, a legacy, their children's lives, all potentially completely devastated along with their plan and their family. Now, if all 20 planned for the lifetime option, you could know with almost certainty that all the planning will still be intact when they need care. Besides, if you polled every client in the room and asked them, do you want income for 3 years or the rest of your life? They're undoubtedly going to tell you, well, I want income for my lifetime. So that was the kind of end of her story. And I kind of like that story because it paints a good picture, in my opinion, of why we need to be solving for the catastrophic. I would never want one of my clients to feel the pain of their long-term care plan falling short. So now here's the problem. A lot of clients think they're in that 30% that won't need care, and you're going to hear all kinds of excuses from them as to why they're in that 30%. Unfortunately, nursing homes are full of people that made those exact same excuses. In reality, people just don't want to talk about it. They just want to deflect that conversation because it's not really a pleasant thing to think about yourself being, having to be taken care of. So now the question is, what do you think of all the stats, excuses, and things that I've kind of shown you so far? It doesn't really work when we talk to clients, does it? Well, at least it really hasn't in the long-term care industry to any great extent for the last 40 years. Now, the reason it hasn't worked for the majority of advisors is that insurance companies have been trying to teach you long-term care language instead of speaking the language that most advisors and clients use. And when you ask about, what long-term care is, most people are going to give you stats, they're going to mention facilities and emotional conversations, but it isn't really any of those things. In its actual simplest form, what long-term care is just another retirement expense. So it's a retirement expense that can cause a client's income needs to just basically increase substantially. So what does that make long-term care insurance? It's not failing 2 out of 6 ADLs, it's not monthly benefits. What it really is is it's simply an income stream we turn on to pay a specific retirement expense. So long-term care is simply another retirement expense, another bill to pay, and expenses impact that income in retirement. So once again, long-term care insurance is really that income stream used to pay for it. So here's a great question for you to start with your clients. If you're not comfortable having a long-term care conversation with them in a very emotional type of way, if you want to be more matter of fact and talk about it with your clients, then do it this way. So in your retirement years, what would be the reason for your income needs to suddenly skyrocket? So here's an example. Let's say you have a client living well in retirement on $200,000 per year. One day they call you to say, hey, I need to begin taking out an additional $100,000 more per year in addition to the $200,000 they're already taking. What's going to cause that to happen? So what's that situation that could cause that potential outcome? Well, when asked, I can guarantee they're going to say it would be some kind of health or medical issue that causes them to become frail and need someone to take care of them. So in our example, however, where would they, the clients, or you as the advisor, find that additional $100,000 plus of income every year? Because remember, they're going to call you, the advisor, and expect a miracle on how to create that additional income stream with assets they already have. So this right here, that's the great retirement income gap. It's that gap between the income they're already earning and then the income they're going to need if an LTC event occurs. So now what we want to do is we kind of take a deeper look at what that income gap is and how it might impact things. So here's just kind of a quick diagram to illustrate what we're talking about. So at age 65, these clients retire and start with an income of $100,000 per year. Now at age 70, they have some health issues, but they can absorb that with some of the reserves. But now let's look here at age 80. Let's say one of them gets diagnosed with Alzheimer's and it lasts until they pass away at age 90. This is the income gap that we're going to see, and this is where we need to create another income stream to fill that gap. This way the retirement plan that you put in place stays intact for their loved ones, their spouse, and their legacy. So here's the solution and the concept of what we do here at One America to help solve that income gap. So basically it's shameless plug time. Now on your screen, you're seeing an example of a client's portfolio. Like most people, these clients have some aggressive funds, some moderate funds, some conservative funds. Well, if I ask these clients, okay, well, what asset would you start to spend down first if either of you needed long-term care? They're likely going to point to something in the conservative funds, probably because it's not earning much or it's the most liquid, easiest to access. So I'm going to tell them, great, now let me show you a way that we can reposition this asset and create an income stream for that exact need should you ever need it and make it a tax-free income stream. So what I can do is I can turn that asset into an income stream to protect the client's entire portfolio and retirement income stream should an LTC event occur for either one of them. Now it's still going to be their asset, but now we have the ability to turn on that income stream if it's ever needed. If it's not needed, we'll simply create a death benefit to pay out to the beneficiaries instead. So here's how it works. So this is kind of like a timeline on your screen. So there's always going to be a base policy that you spend down first. Now it could be a life policy or an annuity, and there's tons of ways we could fund it. We could use lump sums from cash, non-qualified annuities, qualified money, cash value life insurance, or annual premiums to fund that base policy. The beauty of this is that the client can fund this with any kind of asset they want to. So when I ask them what's that first asset you would spend down, or if they would use an income stream that they're getting from some other source, that's the asset or income stream I'm going to use to fund this. Now the client, once again, would spend down this base policy first for long-term care. So day one of being long-term care is kind of on the far left of that base policy block that you see on your screen. And then once that base policy has been exhausted, there's a continuation of benefits rider that kicks in and continues those LTC benefits for the rest of the client's life as long as there's a need for care. Now the rider portion of the contract can also be funded with an asset or annual premiums as well. So conceptually, kind of think of the base policy as a deductible that the client has made with his or her own asset. Like any other insurance, the deductible has to be met or spent down first. Then think of the rider as your catastrophic insurance coverage or as an income rider for a specific retirement expense that can be turned on if it's necessary. So at the end of the day, what you've done is you've created a high deductible, catastrophic long-term care insurance policy. And remember, high deductible insurance, that's what affluent people buy. Affluent people, they're not really worried about short-term care or small risks. What they're really worried about is long-term care or major risks. An example of that is medical insurance. No matter how wealthy you are, you still have health insurance because you wouldn't want to self-insure the risk of getting cancer. You still want to put that catastrophic risk of paying for cancer treatments on an insurance company, even if you could afford it otherwise. And the same thing should really apply to long-term care. Affluent people can self-fund a 1 or 2 year type claim, but you wouldn't want to self-fund an Alzheimer's claim of $1.5 million like we were projecting out earlier. And remember, that was just for an average Alzheimer's claim, let alone a catastrophic 16+ year type of claim. So now what I want to do is kind of talk about your income as an advisor, because obviously that's important. Because we don't want to just protect your client income stream, we also want to protect your income stream as well. So kind of think about this. If your clients aren't prepared for retirement income gap, they'll likely have to spend down their assets much faster than they planned. Now, have you thought about how that's going to affect your business? So imagine as an advisor who gets paid yearly on assets under management, imagine if you had 500 clients age 65 plus who were in wrap or managed money accounts. Now, statistically, we know 70% of these 500 clients will need long-term care in some manner. So what would happen to your income as an advisor if 350, which is 70% of the 500 clients in wrap accounts or managed money accounts, so imagine what would happen to your income as an advisor if 350 of them start spending down their accounts at $100,000 or more per year. What would that do to your income stream as an advisor? What would be a pretty catastrophic hit to your income? So really, it's not just an income issue for your clients, it's also an income issue for you as an advisor as well if your clients don't have a plan in place for long-term care. So now what I want to do is kind of take a look at some of the case design and funding examples using our whole life approach asset care to help solve for that retirement income gap. So kind of walk through some case design examples. So here's our first hypothetical. So we've got a 60-year-old couple, and this couple has done a great job of saving for retirement. They're not really concerned about needing care for the average length of time, but they are concerned for that catastrophic risk of Alzheimer's because they've accumulated assets. So with this couple, let's say they had $165,000 sitting in a CD, and they reposition that asset to fund both a base policy and a lifetime benefit rider. So with one lump sum, everything is taken care of. Now, this setup provided a tax-free income stream of $75,000 for each of them should they need long-term care, or if both needed long-term care at the same time, it's generating a $150,000 income stream they could turn on, tax-free. Now, if you were to invest the same $165,000, you'd have to get a guaranteed 45% rate of return each year to generate an equivalent income stream for just one of them. And you'd have to get a guaranteed 91% rate of return each year to generate an equivalent income stream for both of them. That's the power of what we're doing here and how we're protecting that retirement income gap. If you think you can just take that same $165,000, invest it elsewhere to basically offset that income gap, you just can't do it. And that's why I like to show you down there at the bottom what kind of rate of return you'd have to get them to generate the same income stream that we're going to generate with these payouts. Now, another hypothetical I want to walk you through is clients using unneeded income to fund a policy. So this clientele is typically younger than single pay clients. Typically, we see ages 45 to 65 with this solution. We also see other clients that are pension retirees that don't need the pension income in retirement, so they kind of use that to fund the policy. We also see clients that are still in their working years, but maybe have a good income stream to pay an annual premium. Or maybe it's a client that has a great income rider on a variable or indexed annuity they can turn on to fund an annual pay option. We also see some clients spin off earnings from their managed money accounts to fund policies as well. And then lastly, we sometimes see clients with assets under management using the growth of their portfolio to pay those annual premiums. So a lot of different ways that you can use that income stream or different income streams you could use. So for this hypothetical, we're going to use clients who are in their 40s. They saw that their grandparents went through long-term care and how their parents had to become those caregivers. And now they want to keep that situation from happening to their children and basically make sure their children would only have to be care supervisors instead of caregivers. So huge difference between those two things. So once again, they're trying to make sure their loved ones or their kids were care supervisors, not caregivers, if either one of them needs care. So this couple, both age 45, they've got some health savings accounts for each of them. They've got a high combined income and plenty of life insurance. So this isn't about buying life insurance for them. So what we did here is we took a premium of $5,569 per year, and we used that to purchase both the base life policy and the lifetime benefit rider. We used income to pay for the base life portion. So the base life portion was $3,877 per year. And then we're going to use their health savings account dollars to fund each year's remaining $1,692 per year for the lifetime benefit rider. Now keep in mind, since we can use HSA dollars to pay for the rider piece of the contract, we're using tax-free income for that piece. So it's just another way you can double down on your leveraging opportunity, especially with clients that have those large HSA dollars they've built up for the year and haven't had to use it for a lot of things. Now, if we're using this setup, we've once again created an income stream of $75,000 each, should either one of them need long-term care, or $150,000 of income if both turned it on at the same time. So kind of think about this. If I told you that you could put $5,569 in a 401k each year and turn on an income stream of $150,000 per year, would you do it? I would certainly hope so. That's what we're doing here. Also keep in mind, you could have the same type of setup be funded with required minimum distributions, pension income, or income riders, once again on those old variable or indexed annuities. So if you didn't want to use income or HSA dollars, once again, you could use that pension income if they don't need it, if they're having to pull out required minimum distributions each year that they don't need because maybe they're age 70 and a half or older, or once again, if they've got income riders that they didn't plan on turning on from an old variable annuity or an old index annuity, maybe it's time to turn on that income rider to fund something like this. So now let's take the same concept and do something a little different by reviewing some hypothetical examples using our basically our annuity solutions, which are called annuity care. But before we do that, I do want to point out something that happened in 2010. So in 2010, for those of you not familiar with our annuity care solutions, the Pension Protection Act went into effect. Now, while the Pension Protection Act, or PPA, did a lot of things, it did one specific thing that really applied to long-term care. It allowed for non-qualified annuities that are filed with an outline of coverage for long-term care to be used tax-free for long-term care expenses. Now, one thing I want to reiterate there, non-qualified contracts. So this wouldn't apply to a qualified funded annuity care solution, but it would for non-qualified versions. So where this became huge is with people in that 70 to 85-year-old range. A lot of people in that 70 to 85-year-old range have these large non-qualified annuities with a lot of gains built up in them. So a great idea is to look at your book of business for clients in that age range that have non-qualified annuities and just call them up. Basically ask them, okay, what is this money earmarked for? I can almost guarantee they're going to say the word emergency. And the reason they're going to say that is because at that age, their retirement income is probably well in place. So they don't want to annuitize the annuity for an income stream they don't really feel like they need. And they also don't want to cash out the annuity due to the taxes they would owe on the gains. So these large funds, these large annuities end up just becoming an emergency fund. So now just ask your client to tell you, okay, well, what might constitute an emergency where they tap into those funds? They're highly likely to start describing a long-term care event. So then it's as simple as saying, okay, great, let me show you a way you can use it for the exact purpose, tax-free. I don't know how many clients that would say no to discussing that. So kind of imagine a 78-year-old female with $150,000 sitting in an old non-qualified annuity that's kind of earmarked for that emergency. And let's say she has a $50,000 cost basis and has accrued $100,000 of gains over the years. Well, if she pulled out the funds for long-term care, it's not really worth $150,000 to her because she's going to have to pay taxes on the gains as she pulls those funds out. So it might really be worth somewhere around the $100,000 to $125,000 depending on her tax bracket. But she could do a 1035 exchange into One America PPA compliant annuity. Now when she pulls funds out for long-term care, they're going to come out tax-free. So her annuity is really worth $150,000 to her. And you can't just do this with just any old annuity. You can only do it with a PPA compliant annuity that has that outline of coverage for long-term care. Now, on our annuity care hypothetical, let's say once again, we've got that 78-year-old female, but let's say it's a 200,000 sitting in an old 3% minimum guaranteed interest rate fixed annuity that she doesn't need for income. You've asked her what the money's earmarked for, and she's told you, once again, it's that popular phrase of emergency. Now you've asked her, okay, what would constitute an emergency? And she started to describe that LTC event to you. Now, to make this a suitable replacement, since we're moving from a 3% minimum guaranteed interest rate contract to a 1% minimum guaranteed interest rate contract to solve for long-term care, we need to make sure we have the ability to create a tax-free income stream for the rest of her life to keep her in the home as long as possible. So even though we're going from a 3% guaranteed contract to a 1% guaranteed contract, it's still a suitable sale because it's all about turning this money tax-free for the exact purpose she wants it for. Now, what we've done here for her is we've done a 1035 exchange of the old annuity, and we've put it in a PPA compliant annuity that can be used tax-free for the exact type of emergency she's described. And we've included the lifetime benefit rider as part of that 1035 exchange. So we put, of the 200,000, 165,000 and change went to fund the base policy, 34,000 went over to fund the lifetime benefit rider, all lump sum. So what we've done is we've created an income stream of almost $60,000 per year for the rest of her life, tax-free, and for the exact thing that she told us it's earmarked for. That same 200,000 would have to have a guaranteed annual rate of return of about 29% to create the same income stream elsewhere. So once again, if the thought process for you as an advisor was, hey, I can put that 200,000 somewhere else, invest it, and I can get that same kind of income stream just off the returns I'm going to get her, I don't know where you're going to get 29% returns. So once again, huge opportunity to create that huge leveraging pool and to really get that best bang for your buck as far as leveraging it for that lifetime income stream if that retirement income gap happens to her. Now, another nice thing about the annuity care options is they do have simple underwriting. So there's never going to be a paramed exam, no doctor's records are ever needed, and there's just a telephone interview when you add on the LTC income rider. Well, that's it for today's webinar. I do want to thank everyone for attending. Please feel free to reach out to your marketer or your internal wholesaler today if you want to do some cases on it or you have some questions about what we talked about today. Also, once again, if you have any issues downloading a copy of today's slides, please feel free to reach out to me. Once again, you should have my email address, chris.huntsman@oneamerica.com. Other than that, everyone have a great weekend and thanks for attending.